Accounting concepts and principles. GAAP stands for the Generally Accepted Accounting Principles. These are the rules, guidelines, and principles that entities, businesses, firms, companies, organizations, systems, hospitals follow in the U.S. to guide the preparation and reporting of their financial statements. 1. Entity concept. A company is treated as an entity that is separate and distinct from its owners. Owner and company are two different entities having different liabilities. The assumption here is that a company has its own identity distinct from the owners, creditors, debtors, managers, and others. 2. Revenue recognition, realization concept. Recognizing the revenue means recording the income in the income statement prepared for a particular period. Recognition of revenue should be on the accrual basis of accounting. Events and conditions are recorded in the books of accounts as and when they occur, rather than in the period of their receipt of payment. Accrual basis is a method of recording accounting transactions for revenue when earned and expenses when incurred. 3. Prudence, conservatism principle. The rule of playing it safe. A cautious approach in ascertaining the income of the entity. If a situation arises where there are two acceptable options for reporting an item, accountants go for the less favorable option. All anticipated profits should be ignored, but all anticipated losses should be accounted for. Profits in anticipation should not be recorded, but losses in anticipation should immediately be recorded, even if there is a very remote possibility of occurrence of such losses. 4. Money measurement, monetary unit concept. A factor at transaction is recorded in the accounting books only if the effect of this situation or transaction can be computed in monetary terms. For instance, adverse impact on revenue due to lack of coordination between the front office team and operating room team cannot be recorded in the books of accounts. However, the loss of supplies due to fire or flood can be recorded in the books. 5. Accounting period principle. The accounting period is usually a period of 1 year, and that year can be a financial year, a calendar year, or any year of 12 months. For tax purposes, the accounting period should be a financial year, i.e., a year starting from 1st April to 31st March. The accounting period helps in maintaining accounting records, showing actual profit or loss, establishing the true and fair view of the financial position of the company, and communicating the company information to the intended users. 6. Full disclosure principle. The entity is required to disclose the full, fair, and sufficient information. No information of substance should be concealed in the financial statements. This principle ensures effective communication with the intended users, internal and external. 7. Materiality concept. The materiality principle allows the entity to violate another accounting principle if the amount in question is small enough that the financial statements will not be misleading. Each and every aspect related to the entity should be fully disclosed in the financial statements, but sometimes it is not possible to disclose all the information. 8. Cost concept. Also known as the historical cost concept, cost principle of accounting, cost valuation. Assets and liabilities of the entity should be recorded and presented in accounting records at their historical cost, original cost when acquired. The historical cost method is used for fixed assets. 9. Matching principle. Entities recognize revenues and their related expenses in the same accounting period. Entities report revenues along with the expenses that brought them. The purpose of the matching principle is to maintain consistency across an entity's income statements and balance sheets, and to avoid misstating earnings for a period. 10. Dual aspect concept, duality principle or accounting equation concept. For every debit, there is always an equal credit. Every transaction is recorded in two different accounts. 11. Objectivity principle, verifiability and objectivity evidence concept. Financial and accounting information are independent and free from bias. The financial statements are based on solid evidence. 12. Timeliness principle. Accounting information is to be presented to the users in time to fulfill their decision-making needs. 13. Substance over form principle. Financial statements give a complete, relevant and accurate picture. Transactions recorded in the financial statements must reflect their economic substance rather than their legal form.